Welcome back, everybody. Unfortunately, the last week wasn't any better for Chinese stocks, as Hong Kong Stock Exchange, Shanghai Stock Exchange, as well as Shenzhen Stock Exchange, both further dipped down into the red, or in Chinese that's actually green. But the bottom line is basically there's currently a very low confidence in the stock markets in China. The valuations are very cheap and everybody's just waiting for the big stimulus. And today in this program, I want to show two more opinions that I think are against the mainstream narrative out there. So I'm targeting a couple of topics like here, the Evergrande crisis, which was also refreshed last week, but also more about the Chinese economy in general and so on. So stick to the very end, in which I also play back a video of another investor which is having views on China and which I find quite insightful and at least a different opinion. That's always what I'm trying to show here on the channel. But first, I'm going to jump in this little leaflet here. This is basically coming from a LinkedIn post by Frank Sieren, and he's a German guy living since I think 30 years in Beijing. Actually, you can go back onto my previous videos where I've done an interview with him, and he's one of the more reasonable voices out there around China, and he's just done this little LinkedIn post here, which I'm now going to simultaneously translate because it's actually in German. So for the German watchers, go and follow him on LinkedIn, where he does those sorts of posts like every week or something. And now I'll just go into the English version here. So this is about the Evergrande story that happened, that the Hong Kong court has ruled, that it's now bankrupt and they are going to go after what's left. And he's concluding here, firstly, that the state has not bailed out Evergrande. No, they just let them go bankrupt. And there are a couple of reasons why that's happening. So it's also funny because sometimes people think China is a communist country, right? And it's going to bail out everybody who needs help and the state is going to step in. But in fact, they're doing something which is quite capitalistic here, and letting a private company, a market participant, go bankrupt and kind of let the market solve it. Which is also a little bit different to what we sometimes see in the West when we see companies being bailed out, and like during the COVID crisis and so on. But anyways, that's another topic. So what happened is that the stock prices actually of other developers have been going up when this news was announced, because this bankruptcy is now bringing some sort of clarity here. So they know that somebody who's messing it up will not be bailed out by the government, essentially. And Evergrande is not too big to fail. So usually when we read like the Western media headlines, it always sounds like Evergrande is this huge drag on the entire Chinese economy, but it's only 4% of the market share in China in the real estate sector. So it's quite significantly smaller than something that you would deem too big to fail. That would be a systemic risk. And I think I said it here a couple of times on the channel, that in case something's happening that I feel would be systemic, so creating a domino effect, or is really large enough, then the Chinese state, I think the government would step in and would bail them out. But Evergrande, not the case. It's not big enough. So what the government is doing instead is they're helping those who are waiting for the houses to be built. Because the developers had too much debt taken on, they couldn't finish the project, so the government steps in there. So this is kind of helping those clients who otherwise would possibly start and go out and protesting. But that's what the state is doing here. So what else? It's also a misconception that there are lots of faulty or bad credits out there in the Chinese economy. So the bad credits are only 1.6% of all credits. So the The Chinese banking sector in this regard is not near to having lots of shady debt that might be difficult to work through or something like this, right? So this means also that there is some sort of a healthy financial underlying in the economy there. And the share of the real estate sector for the GDP is around 14% only. So all of this doesn't point to the fact that there is a huge systemic financial issue underlying here with those debts relating to the real estate sector or Evergrande here. What's actually the situation here is, if you compare the real estate percentage of GDP, only 13% is actually owned by the real estate developer, so the smaller part, whereas actually 30% is by the clients, the owners who are taking on bank loans in order to finance their property, right? But it's very unlikely that those private customers and owners will become illiquid. First of all, the first point is they need to make very large deposits and down payments in order to do so. So usually around 30% or 20% for the first apartment. By the way, there's only up to 2 apartments that a family can actually start owning. And so, all of these are already limiting factors. And at the same time, while everybody's talking how bad the Chinese economy is going, in 2023, there has actually a 5% increase of household income in China. So I know most of that is going currently into savings. But it's really not that they are currently going through some sort of a liquidity squeeze here on those who are owning the debt, right? And Frank Sion makes a point here that he actually doesn't think that the market participants think that the bubble is going to burst. Actually, this is also reflected in the prices. Why we hear all of these slogans around that the prices are collapsing, that's actually not the case. They're quite stable, actually. However, what's currently happening is that there are less transactions. So the prices for apartments, for example, have just been down 0.1% in the last report. I think I also made a video about that. So, that's not a steep decline, although the Bloomberg headlines make it sound like it, since we are going through a longer period in time in which the prices are actually declining and not going up. But what's really the issue, the underlying issue currently, is that there's not many transactions happening, or let's say there are fewer transactions happening than in the past. So that means that people are actually waiting for making their purchase decisions, and they are possibly thinking they might be able to strike a better deal in a couple of months, or maybe also there is just a confidence issue, because this is mostly about these first-time new real estate buyers who are looking to buy those development projects. They are indeed down. However, the second home real estate purchases have been actually increasing by 19%. The case really is, this is more a trust and a confidence issue with new development projects, but not so much in general about real estate. He's also pointing out the fact here that 25% of Chinese are only part of the middle class, while in the US this number is at 50%. In Europe it's actually even 70%. So it's going to take around 20 years more for the Chinese middle class to actually catch up, and that means lots of money needs to go into real estate. Lots of people need to purchase new homes, so there is some sort of a demand coming. However, he's also pointing out here that 70% of investment in real estate as an allocation is too much, and that's what I've been saying for some time now also. And I actually made also a Twitter post recently in which I pointed out to the fact that this drop in the stock market should be a huge change for China. They should actually do something like make a 401k mandatory, so that employees have a certain amount of their income actually being allocated to the stock market, maybe also with a little boost by the government, so maybe 10% by the employee, 10% by the government on top of that as a tax break, something like this. Just make the incentives that people are starting to save also into the stock market, and have this as sort of a tax benefit scheme and then also a retirement scheme. I know some of those regulations are in place or coming into place, but it's just tiny and not in this, what you usually know about China, these huge holistic reforms, right? It's just too small of a reform as of now. But having these Chinese stocks trading at these low valuations, it would be a huge opportunity for China to create such an incentive system and then make their population more wealthy, with future gains if everyone does that over a continuous time. And actually, next day, and I'm not claiming any relation here, but PBOC's Yigang just basically came out and said that there needs to be a larger allocation to the stock market. And I'm hoping that's coming at some point in time, maybe in a structured manner, maybe in a big reform. But anyways, this is a little bit of an alternative take here. By the way, of course, also pointing out the negatives and that there are structural issues here, which I agree to, that real estate in China is too expensive if you compare it to the personal incomes. It's just bubbly in that sense with the prices, and that's also why it's one of the declared targets of the Chinese government to deleverage this sector and also to bring down prices a little bit. And it seems actually they're succeeding with that, because it's not crashing down, but it's coming down gradually. And ultimately, this should be good for people in the end if they, if normal citizen will be able to purchase houses at lower cost and then possibly able to invest in the stock market, diversify their financial wealth somewhere else, and have more money for spending on consumer goods. That could be an outcome that the government is pointing to. And that leads me to the next video, which I will leave uncommented, but I think it was worth showing that one. Different perspectives also on this matter, on real estate, as well as other topics like demography and so on.
So I do think that China has some real long-term challenges, and these have been talked to death by the Western press. But are these insurmountable? In my opinion, no. In the short term, I think China is clear it's facing some confidence issue, and a big confidence dampener has been the weak property sector, as my colleagues have pointed out. But if China can turn that around and couple that with some reforms, it can actually still do well for the next 10 to 15 years. And with regards to the comparison between China and Japan, I can appreciate why people started comparing them. There are some similarities, but there are importantly a lot of major differences as well. So the first difference is that China today is very different from Japan in the 90s, especially in terms of potential GDP growth. To put that into context, for Japan, in terms, if you look at real capital stock per capita, China's numbers now are a fraction of that of Japan's in the 90s. And secondly, if you look at the property bubble, the asset bubble that we see in China today, again, that is not as big as what we saw in Japan in the 90s. Just comparing property value as a percentage of GDP, Japan in the 90s was about 560%. China is less than half of that at 260%. And importantly, the stock market then, Japan also had a huge stock market bubble in the 90s. Stocks were trading well above 60 times, whereas if you look at the HSCEI today in China, that's at a mere 7.5 times PE, which is a very low level. And the next point is in terms of what happened when the bubble burst in the 90s was that the Japanese government decided that they needed to tighten monetary and fiscal policy in a very extreme manner. Whereas in China, the policy environment is still extremely easy. Financial conditions are getting easier, if anything. And the next point is that China has a very stable currency right now, as Ian alluded to earlier, especially on a trade-weighted basis. Whereas Japan in the 90s, what happened was that the yen appreciated more than 200%, which made Japan extremely uncompetitive. And the other thing that people have been talking a lot about is the demographics issues in China today that is very similar to that of Japan. Yes, we know that China is aging. In fact, if you look at the working age population, that has kind of peaked a couple of years ago. But I'm actually still fairly comfortable with the demographics for next 10 to 15 years. Why? Because retirement age is still fairly low in China. It's for females, it's about 55 years old, and for males, it's about 60. So there is a lot of room to move that up. And the last point I will just talk about is that I mean the Western press would always talk about how China has a debt issue. But in our opinion, China's problem is not having too much debt, but in fact they have too little debt. Let me explain that a little bit more. I
Mhm.
think what I think you can certainly argue that China has a problem with debt concentration, um, especially in areas like property. But the problem for China today is its big savings imbalance. China has one of the highest savings rates in the world today. And if you compare that to their investments, that is actually gonna only come down structurally, especially as they transition
Mhm.
away from property. So there is a huge excess savings. And on their debt level, if you look at China's private debt, it is actually in fact lower than that of the US, South Korea, Japan. And public debt-wise, China is at 71%, which is significantly lower than that of the US and Japan today. So, and the other thing that you have to consider is that the Chinese government also owns a lot of assets. And if you take all those assets into consideration, their balance sheet is actually net cash. So the bottom line here is that China, with its high savings economy, they will need a lot more debt creation and accumulation. The bigger the savings pool, the more borrowing and lending needs to be done for financial intermediation. So in the past, China could get away by exporting that, but of course, we know that exports in China are also limited by geopolitics these days. So the only way out is really for the Chinese government to be spending more. But all in all, I would say that the playbook for growth in China is very different from what we have in the West, where it's purely just about boosting consumption. China wants to boost consumption, but it also wants to transition and pivot the economy towards advanced manufacturing, or what we call advanced industrialization 2.0. And these are in the area of EV, renewable tech, automation, robotics. These are the areas that they want to offset the weakness in property. And if they can do some proper reform during this period, stabilize the economy, and transition successfully towards advanced manufacturing, I do think that China can still do fairly well over the next 10 to 15 years.
Mhm. And where's your interest in terms of what are the parts of the equity market from China that you think are the most appealing today?
So yeah, as I discussed earlier, we are looking at advanced manufacturing because
Hmm.
that's where we think that China is pivoting towards. So we know that already in clean energy supply chain, China dominates, um, especially for the global supply chain. Where we are actually looking a lot more in is in the EV space.
Hmm.
China today is a bona fide auto export powerhouse. In fact, if you look at this year, they've just overtaken both Japan and Germany in terms of auto exports. And for China, it's not just about dumping of cheap China cars either. Um, if you've For those who've had the experience of sitting in one of the new EVs in China, you would see that the quality of the entire car is actually very comparable to um, its foreign counterpart, foreign OEMs, in fact, even better in some instances. So the innovation in China is just massive because the competition is intense.
Hmm.
All these companies are forced to really invest in R&D over the last few years. And of course, for China, cost is always a big advantage because of the economies of scale. China simply has a lot of people. They have 1.3 billion people as a base. So cost economies of scale is always an edge for them. But having said that, the Chinese in terms of valuations right now, 7.5 times. I think there's a little bit of disconnect. Um, is it going to go back to yesteryears in terms of valuations? No, but I mean, what we've seen today is that the economy is stabilizing. I mean, if you look at the economic data from the last 2 months, whether you look at it from the perspective of PMI, industrial profits, exports, the data tells us that China is already bottoming out cyclically. And on the other hand, the pace of easing has also accelerated. And you see that across from property to the way they treat the capital markets, and encouraging margin lending, margin financing, and the capital markets, and also boosting the fiscal deficit. So a lot of things have been done, and yet here we are. Valuations have gotten cheaper. Of course, they will need to still fix the main problem, which is just what we're talking about today. This is the property problem. They need to fix that. And if they can stabilize the market, and again, to run some reforms, I do think that this is an opportune time for long-term capital to be picking up very good quality companies with high sustainable returns, very strong positive fundamental changes at a discount.
So again, I hope you find that interesting. By the way, this is the book of Frank Sheeran, and let me know in the comment sections how you see those kind of different opinions here by those two experts. Thanks for watching, and let's hope that things can recover soon.